Hi, our lecture today is about problem solving about capital budgeting. Here is an example. We have three different proposals. The first one is expansion, while the second and third are replacement. So let's start with the first one. In case of the first proposal, the cost of new asset 1,500,000, installation cost is 0, and the annual net profit before depreciation and tax is 250,000. So let's start with requirement number one. Number one, calculate for proposal one the initial outlay. Initial outlay is calculated as cost of new assets plus installation cost. And as this is expansion, so there isn't any replacement is going to be made. Okay, so the cost of new asset is 1,500,000, and there is no installation cost as mentioned in the example. So this is the initial outlay, 1,500,000. Now let's move to requirement number two. Calculate the depreciation expense for year one. As mentioned in the example, that this asset will be depreciated in 10 years. And according to MACRs, depreciation for 10 years will be 10% for year one, 18% for year two, and so on. So here we would like to calculate for year one. So it's calculated as the initial outlay multiplied by the 10%. So the depreciation for the first year will be 150,000. Number three. Calculate for proposal one the annual incremental after tax cash flow. After tax cash flow equal earning before taxes minus taxes plus depreciation. Earning before taxes is calculated as annual net profit before depreciation and tax minus depreciation So from our example, the annual net profit is 250,000 and the depreciation is 150,000. So this will be 100,000. This is gonna be multiplied by 0.4, which is the tax rate, in order to find the deducted tax. So after tax cash flow equals earning before taxes minus taxes plus depreciation. Earning before taxes is 100,000 minus taxes. Taxes will be 100,000 multiplied by 0.4. This is taxes. So it will be 40,000. And now we are going to add the depreciation, which is 150,000. So it will be 210,000. Now let's move to proposal 2. With respect to proposal 2, cost of new asset is 200,000. There is no installation cost. It's depreciated in 5 years. With respect to the old assets, the original cost of the old asset is 80,000. Sale proceeds of the old asset is 50,000. The purchase date of the old asset is 2010. And finally, after net profit before depreciation and tax of the old asset is 30,000. And with respect to the new asset is 100,000. Okay, number 4, calculate the book value of the existing asset at the end of the 4th year. The existing asset has an initial value of 80,000. And this is going to be multiplied by 1 minus, we would like to find the book value, okay, after the depreciation of the assets. The asset will be sold after 4 years as it's bought in 2010 and will be sold in 2014. It will be depreciated after 5 years, okay, in 5 years. So the depreciation rates will be used are 0.2 to 20%, 0.32, 32%, and 19%, and finally 12%. So the book value of this asset is 13,600. And now we would like to calculate the tax effect on the sale of the existing assets. The existing asset will be sold for 50,000. And has a book value of 13,600. So the net value will be taxed by 40%. So it will be 14,560. Number 6, calculate the initial outlay for the second proposal. The initial outlay in case of replacement is calculated as cost of new assets plus installation cost minus sale proceeds of old assets plus or minus taxes on sale of old assets. The cost of new asset is 200,000. There is no installation cost. Sale proceeds of the old asset is 50,000. And from our calculations, the tax effect of the sale of the existing asset is 14,560. So the initial outlay is 164,560. Number 7. For proposal 2, calculate the incremental depreciation expense for year 2. Here we have to calculate the depreciation of the old asset and the depreciation of the new asset. You do not have to calculate for all years, okay? Just for year 2. But here, in order to explain more, I'm going to calculate for years 1 and 2 and 3. With respect to the old asset, it will be sold after 4 years. And we know that the depreciation rates are 0.2, 0.32, 0.19, 0.12, 0.12, and 0.05. So it will be sold after 4 years. So we are going to start with these two. So it will be 80,000 multiplied by 0.12, which is 9,600. And for year 2, it will be 80,000 multiplied by 0.05, so it will be 4,000. For year 3, there is no depreciation, so it will be 0, as the book value of the asset in this case will be 0. Okay. Right. With respect to the new asset, it's 200,000 multiplied by 0.2, which is 40,000. And for year 2, 200,000 multiplied by 0.32, 64,000. And for year 3, it will be 38,000, and so on. The required is the incremental depreciation. Incremental depreciation is the difference between the new and the old. So it will be 64,000 minus 4,000. It will be 60,000. Number 8. Calculate the annual incremental after-tax cash flow from operations for year 2. Here we have to calculate the annual after-tax cash flow for the old and the new. Let's start with the old. From our example, the annual net profit before depreciation and tax for the old asset is 30,000. So as a first step, we have to find the annual net flow after depreciation and before tax. So this is minus depreciation, which is here in this example, we assume that the annual net profit before depreciation and tax is constant for all years. So this is annual net profit is 30,000, 30,000, 30,000, and so on. And the depreciation rates as calculated is 9,600 and 40,000, and 4,000, 0 and 0. So earning before taxes will be the difference between the annual net profit before depreciation and tax and depreciation. So in this case, it will be and then we are going to impose tax. So taxes will be 40% of this value. So it will be 8,160. So the annual after tax cash flow is the difference between before and taxes. But as we said before, that we have to add depreciation, as this is after tax and depreciation, but we would like to find the after tax alone. So we are going to add depreciation once again. So it will be 21,840. We are going to do the same for year 2. So it's 30,000 minus 4,000, 26,000, multiplied by 40%, which is taxes. It will be so the after tax and the depreciation cash flow will be then you have to add depreciation once again. and so on. And now we have to do the same for the new asset. This is for the old one. We have to do the same operation exactly for the new assets. So it will be $200,000 minus the depreciation, which is 40,000 for the first year, and then multiplied by the tax rate. Find the net value and then add depreciation once again. So this is what we are going to get. This is for the old asset and this is for the new one. And so on. So the incremental cash flow, as we said before, is the new minus old. So it will be new minus old. 2 minus 1. This is 2 and this is 1. So it will be, so if it's required in the exam to calculate it for only 1 year, so please calculate it for only 1 year. The same will be the case for proposal number 3. Thank you and best wishes for you.